quality assets, A, B assets in quality locations that have a stronger, more resilient demographic, so your higher income earning, middle working class type demographic that can absorb a inflationary period like we're experiencing today, right? And if you look at the economic impact from what we're experiencing now, everybody's being negatively impacted. I mean, we're all of our pocketbooks are hurting, of course, but when you have an income earner that's earning $80,000 or $100,000 a year, $4 a gallon of gas doesn't have the same impact as somebody that's only earning, $30,000 or $40,000 a year. And that's what we're seeing in our portfolio as well, is the demographics in our A-class assets are able to, have a little bit more elasticity when it comes to market changes versus what we're seeing in our C-class properties. Brian, you got anything to add there?
Yeah. So Cody and I spend a lot of time on a lot of investment webinars, both for real estate and other things. And we've seen this and we saw it coming because we watch a lot of operators that are where we want to be. And they've all made a very strategic flight to quality. And they were doing it a little earlier than a lot of other operators are doing now. There's more people following this suit. But we've seen data as of recently in Q1 where your A class assets, for example, and your B plus asset had 15, 16, 17% rent growth, where your C class assets were just north of 8. Now, 8% rent growth is still phenomenal, but you have to also remember that inflation is 8.6% the CPI index last month, right? So essentially your C-class assets, yes, your rents are going up, but just enough to keep up with inflation, which is great because real estate is a hedge against inflation. But our strategy that we pivoted to a little over a year ago, we sort of saw the writing on the wall, seeing what the other operators were talking about, and also looking at the data, going back to what John provides a lot of value in, and seeing like, hey, right now, the best strategy is we're seeing the most growth in the A-class space and in the solid B plus space. Let's go ahead and shift our focus. Even though these assets are a little bit larger, they have a bigger sticker price, we feel more confident, more secure taking investor capital, being that fiduciary, parking it in a more secure asset over the course of the long haul. And these are the tenant bases, as Cody said, that are going to be able to take those impacts, your workforce housing spaces. That's a tough area. Those guys are getting hit the hardest, unfortunately. So trying to go in there, acquire property, even though you're doing a value add play, and maybe you're doing $2-3 million with CapEx, trying to move somebody's rent $200-$300 when they already are barely living paycheck to paycheck. That's a tough pill to swallow. And we didn't want to be caught up in that mix. So that's why we had that pivot to the more quality housing.
Yeah. And then when you talk about quality, there's also location and the physical aspect of quality.
Sure.
So is it kind of more so the A-class buildings in a good location? Is the location more important than the physicality of the asset?
Yeah, 100%. Yeah, I mean, because people are going to want to live in places that are in high demand. A location that's close to large employment centers that have easy accessibility to whatever impacts their day-to-day lifestyle, right? Whether that be activities, jobs, etc. Now, when we talk about location as well, you can get very granular and talk about like specific micro markets and sub markets within an MSA, but as a broader scope, you have to really look at secondary, tertiary markets versus primary markets as well, right? That's another hot topic item right now is, for us in our thesis, looking at risk mitigation, being in a primary market like Houston, where we're based out of, San Antonio, any of the Texas MSAs, really being in a dense populated MSA gives you a lot of security in the long-term execution throughout your business plan, right? You have a diverse economic base here in these MSAs. You have a large, dense population. So your risk mitigation is much lower versus if you're going into a secondary, tertiary market that has a much smaller population, maybe 1-2 economic drivers or employer bases that could be easily impacted by an economic downturn. And so I think it's important to take that consideration. Probably more so than the characteristics of the building, because I guarantee you people they'll still rent, a 70s, 80s C-class product in an A-class area, right. If it's convenient for their lifestyle.
Yeah, it's kind of like the hot commodity, because then you can scale down and save money in these assets potentially. And Brian, then have you kind of adjusted the investor expectations due to the recent changes and et cetera? Because we know capital return is probably going to take a longer time, and with the same underwriting, et cetera, may not be, because maybe hopefully you are using very conservative underwriting, et cetera, so that is mitigated. But have you kind of adjusted having these discussions with your investors to say, hey, moving forward 5 to 7 years, or perhaps it looks different than the last 5 to 7 years?
That's a great question, and something we're talking about regularly to our investors as well. So one, from a metric standpoint, yes, you do have to adjust expectations, especially if you're looking at an A-class product. If you're looking at something that's 2010s and up, it's not going to produce the same returns as a value add play that was built in the 60s and 70s. Now it's risk adjusted, right? So the risk, there's less operation and executional risk there because you're not doing a heavy CapEx. So your returns are going to reflect that. So that's important for us to look at. If we see 5-6% cash on cash in an A-class property, we get very excited about that because, again, it's risk adjusted versus maybe a 7 or 8% or higher in a C-class asset. So that's really important. And then two, for us, based on, market cycle is the hot topic right now. Everybody's talking about inflation and all the things going on there. So for us, we're talking to our investors. Our goal is to make sure we stay flexible. So we want to make sure we understand, look, what's happened in the last, call it 5 years, where you're selling these properties and doubling your money in 2 years. That's probably not going to be what's happening going forward. So we condition our investors to understand, look, these are long-term holds. And by long-term, we just mean we want to execute the full business plan, which might be 5 years, might be 7 years, or maybe it's longer, but we want to have the flexibility to make sure that we can exit when the market is right. I wouldn't say at its peak, because you can't time the market and say it's at its peak, but we want to be able to execute when it makes sense for our investors. So maybe it's 3 years, maybe it's 5 years, maybe it's longer, but keeping that expectation in check is also important. And then also, just depending on, the investment and the opportunity, understanding the expectations as far as cash flow. If we're going in and we're looking at a property that has floating rate debt, for example, in a rising interest rate environment, there might be parts of the deal where maybe cash flow is a little tighter and distributions get held. So these are a lot of common themes that we're hearing around the industry from a lot of operators as well. It's just conditioning their investors to understand, look, this is a preservation of capital play. Right now, the equities market has gotten absolutely crushed. If you're in stocks, you're very sad right now. If you're in crypto, you're also very sad right now. So what type of asset class can I look at that is going to at least preserve my capital, and I'm going to get some long-term appreciation in a risk-adjusted basis, in a quality asset, in a quality area, in a quality location, and a growing MSA that has lots of jobs? That's where real estate steps into play. And that's really our strategy and our communication to our investors.
That's right. Yeah. And then I looked at your portfolio. You have one property in Ohio, and then the rest of the remaining of in the Texas, but split between kind of the Dallas-Fort Worth area and the Houston area. How do you manage these distributed assets, meanwhile kind of keeping eyes on scalability?
Yeah, well, looking at the evolution of our portfolio, we were just like anybody else is getting started. The barriers to entry were so high, right? And so the fastest and quickest way to kind of get your foot in the door is by partnering with other experienced operators. And so that's the exact approach that we took. We started partnering with other operators that had successful track records, that had a lot more experience than we did, that we could add value to and their team. And in this case, bringing our equity and our investor database to some of these deals. And so, the deals like in Columbus, Ohio is a great example. Dallas, a great example, where that was partnerships with experienced operators who had experiences in those MSAs or those markets that we could participate on, even as co-GPs, right? As co-general partners. And so they're the lead sponsors. They're more responsible for the day-to-day asset management, so to speak, and things like that. And we're just an integral part of the team as co-general partners. But when it comes to our acquisition pipeline, obviously we're focused just here in Central Texas, Houston, San Antonio. But that's kind of really how we look at the diversification of our portfolio across multiple markets, is having boots in the ground, having other experienced partners that are in those target markets that really we can rely on to disseminate the workload across.
Yeah. And I think it's important to highlight, no matter where you buy a property, you're probably not there every day, right? So it's not like you're on site every day. So you really have to have systems and processes in place, whether, on your weekly asset management calls, your follow-up kind of in between your calls, regardless if you can get out to the property or not. Like Cody mentioned, you want to have a great partner on your property management side. So you want to make sure you're hiring a property manager. If you're using third-party property manager that has a footprint in that market, you don't want to be their first customer and that has experience in multifamily in particular, especially if they're larger assets. So that's really important, having that quality partnership on the asset management side. And then you definitely want to have somebody that's boots on the ground, that lives in that market, somebody that can be in the, be by the property within a matter of hours if necessary, just in case, there was you need to be there. So as long as you have those two things, it doesn't really matter as much. You don't want to scatter yourself too thin. Obviously you want some economies of scale trying to invest in the same market, but it doesn't really matter where you invest from. There's tons of people investing all the way across the states. We know people that are in Europe investing in the US because they follow good systems.
Right.